This is Spencer with Numbers Up Finance. Today we have a quick market outlook video for January 2nd, 2019. I'm going to start off this video looking at the very macro trends of the market. And the reason that I'm doing this is because in this video I'm going to be talking about how I'm looking for an entry long. But I think it's important that I emphasize the fact that I am still bearish for the long-term outlook for the market. And it all depends on what kind of trader you are. Some people might not be comfortable with taking a long trade when they see a very macro bearish trend going on. But I'm a very active trader, so I feel comfortable. But I'm just going to lay out exactly what I am expecting and what I see on the charts. So starting off with this monthly chart of SPX, we can see that we're right on top of this this purple line. This purple line is a moving average of 40 ticks, so 40 bars for a moving average. 40 months in the case of the monthly charts. And there's nothing technically significant about us landing right on this line. Usually the moving averages don't mean that much when you go, above like 50 weeks. Anything past that is really just kind of, it's too long term for it to be of any significance. But the reason that I'm showing you this chart is just because I want you to see the magnitude of the stock market movements right now. And I'll say this, my overarching thesis for the next couple of years, maybe 2 to 3 years at most, but I think that we're entering into a bear market. I think that this high that we put in back here a couple of months ago, I think that this is going to be the highest point in the market for the next coming years. Now, that I might be wrong, I might be totally wrong, in which case I will hopefully change my opinion or my outlook on the market. But let me say this. If we're entering into a bear market now, this moving average does a great job at highlighting how far down we can expect the market to drop. So you can see back in 2007 and 2008, we had this bear market that was the housing market crash. And as you can see, it came down to this moving average and it stalled out for a little bit, but it fell significantly below. This is a drop of about 50% below that purple line that we're on right now. And then likewise, early 2000s dot-com bubble, we fell about, it's hard to say exactly where the purple line is, but somewhere in the midst of 30 to 50% below that purple line. So, bring that forward to today, 2019, now that we're just in the new year. If we are in a bear market, there's a significant amount of downside ahead of us. And I do believe that we are entering into a bear market, which might sound confusing, given that I'm looking to enter long, but I'll explain that moving forward. So here we've got we have a one-day chart, a very long-term one-day chart, and the thing that I want to go over on this chart that makes me say that we have more near-term future upside is this blue line here. This blue line here is the 200-day simple moving average. And it is actually a very technically significant line to trade with. And basically what that means is that there's a lot of reaction points that you can see off this, both heading as and acting as a support. And before you can see maybe there are some points where it acts as a resistance too, which is kind of what I'm expecting to happen now. But even more so than that, I think what's significant about this blue line is that it kind of acts as a magnet for the stock market. Now what I mean by that is when we get incredibly far above it, we tend to snap back right to this line or approach it to some extent. And when we're incredibly far below, we tend to snap back and come very close to this line. And as you can see now, we were incredibly far below this line, about 15% for the S&P 500. I'm not sure exactly what QQQ is, but it's probably something quite comparable. And even still, even after these past couple of days where we've had this 7-8% run up in the indexes, we're still very far below this blue line. And so disregarding technical analysis, just from a simple probability standpoint, I think it's very unlikely that we push past this low in the near-term future. Once give it a couple of months and let the moving averages catch up, and maybe then we can see that we can continue to move farther down as I expect. But in the very near-term future, I think it'd be highly unlikely that we see that we break these lows that we made a couple last week. And maybe I'm wrong, but if so, that's why we use stops. And one more thing, even when we're in the bear markets, let me scroll back. Oh, let's see, I need to change this chart time frame. Sorry. So let's go back to the housing market crash. In the housing market crash, we can see something that's pretty comparable to what's going on now, right? Where we get in these highs, and then we finally impulsively cross below it, which is exactly the point that we're at now. We just finally impulsively crossed below this 200 moving average. And even still, we saw one complete snapback to the 200 moving average where we tested it and it acted as a resistance before it shot back down. And then even a second time we saw where we tried to rally back up before we got that final plunge down that brought us to the low point of that bear market. And so going forward, in the near-term future, look, we had a nearly 20% drop over the course of a couple of weeks. And in the markets, it's very infrequent that you get these very profound movements that are unidirectionally, meaning that they move in one way, for extended periods of time for great magnitudes, right? So we had this long period where we're just selling and selling and selling, and it's very, very rare that we get that. Now, I mean, you can see that we've had a snapback already, and the same thing applies in reverse. We've had a pretty decent amount of time where we've had very significant buying, and so this just brings me to my overall outlook, what I'm looking for to happen this week. I'm looking for tomorrow, Wednesday the 2nd, maybe even to the end of the week, that we get some amount of pullback. And this pullback is nothing to do with, well, it has something to do with, but not a lot to do with technical analysis, but more so just to deal with the fact that we're we're on the micro time frame, we're overextended to the green side. We were very incredibly overextended to the oversold side. But now we've kind of snapped back to that, but we still have more upside in my personal opinion. I'd expect, looking at the S&P 500, the SPY index, I've got two levels marked out here for resistances. These would be possible reversal points that I would expect. The first of which being the 2018 lows at the beginning of the year before we broke them right at the end. You can see a nice double bottom here that could act as a very nice resistance. We also see here there's a couple reactions right around this 264 line. And then my very maximum long-term pullback outcome, I said that wrong. My maximum target range for a shoot up here would be the 200 moving average all the way up here. I don't expect that to happen. I'd be very surprised if it does. But even though I'm expecting a little bit of pullback in the next couple of days to the downside, I'm expecting us to have another thrust up later, and I'll explain a little bit more in depth as to why I'm expecting that. But let's take a look at QQQ real quick. One thing that's kind of important to note is that QQQ and SPY right now, the resistance aren't quite aligning. QQQ is actually at a pretty strong resistance right now. You see the double bottom that it made in 2018, just like SPY. It is right at that resistance zone right now. And so maybe we get a little bit of thrust up, but I'm expecting a small reaction in the next couple of days towards the downside. And so the next thing that I wanted to point out is looking at even more micro term charts. Let's look at the 1 hour charts for everything. We can see that on the 1 hour charts, there are pretty clear bearish divergences in play. So you can see QQQ is making higher highs here, but the momentum indicators are starting to point down, which is part of the reason that it's leading me to believe that the next couple of days we're going to have a slight breakdown. And SPY, you can see very similar thing. You can see it's starting to make higher highs, but the momentum is going down. You can actually see this on the futures too, I should point out. The futures are actually a little bit more clear for this, but ES, so the S&P 500 E-mini future, clear higher highs, momentum going down, and then just real quick, NQ is the exact same way. Higher highs, momentum is sharply pointing down. This leads me to believe that the next couple of days we're going to see some downside, but again, I already mentioned it, I don't expect us to be breaking this low anytime soon. We might come down and test it again and put in a double bottom, but I'd be very surprised if we continue to break it and continue this waterfall selling down that we've seen over the past month. Okay, and so just to basically sum up my opinion on the market right now, we are still incredibly oversold on the daily charts. We do not get these movements in one direction for such a significant amount in such a significant period of time. It does not happen very often, and even though we've had a couple of days of run up, I'm still expecting the next significant move to be a move in the positive direction. And the two reasons that I say this, the first one is obviously I mentioned it, we're still incredibly overextended. This blue line acts as sort of like a magnet on the 1-day chart where the stock, regardless of whether it's bear or a bull trend, it's going to tend over the course of a couple months, when it's overextended either direction, above it, below it, it's very likely that it's going to snap back to it at some point. It's just kind of hard to predict exactly when that point is going to be. And the second thing that leads me to believe that we're going to see another thrust up in the coming weeks is market psychology. So I mentioned that the small charts, the 1-hour charts for the 20-day 1-hour charts for the indices, I'm expecting there to be a slight pullback the next couple days. And how this might play out is if we start to move down here a couple percentage points, people are going to start to be very apt to enter back into shorts or to sell their long positions. And when everybody is expecting one thing to happen, so if we go down a little bit, everybody's going to be expecting another waterfall sell-off. When everybody is expecting one thing, you very rarely get it. The market does not work that way. If we see a slight pullback, that would be a very objective point, in my opinion, for a bear trap. Where general market sentiment becomes bearish, and when that happens is usually when you see the greatest spikes in the opposite direction. So if the general market sentiment is incredibly bullish, like it was back here early 2018, incredibly bullish sentiment, that's when you get these very quick, rapid snapbacks in the opposite direction of whatever market sentiment is. And so we've seen now the overall trend of the market is becoming very bearish. People are adjusting, traders are adjusting, the market is readapting to the new way that it is. And so this rip here, if it starts to be faded, people are going to be very quick to jump back onto this bearish bandwagon. When you see that sentiment spike up like that, that would be the very time that you're expecting a nice rally, a nice thrust up that we could get to end it. And so that's where I'm going to leave this video. If you liked it, be sure to leave it a like, subscribe to us, leave a comment in the video. Any criticism or compliments or anything that could help us out is greatly appreciated. Until next time, make sure you keep your numbers up. This has been Spencer with Numbers Up Finance. I hope you have a good one.